Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. In this week's episode, we explore the growing strategic alignment between the UK and the US administration. Perhaps another unexpected benefit of Brexit. Only time will tell. We'll also take stock of the region's slow and uneven path to recovery, with PMI data pointing to a recovery that continues to be postponed. And finally, we look at how global trade dynamics, particularly China's export pivot, are sending ripple effects through Europe's inflation outlook and competitive landscape. All right, let's get stuck in. Last week, US President Donald Trump visited the UK on a state visit, meeting with both Prime Minister Keir and King Charles. While much of the media focused on the ceremonial aspects, there was meaningful business conducted behind the scenes, activity that could potentially support the UK's ongoing efforts to reignite economic growth. The most notable development was the signing of a tech prosperity deal, a memorandum of understanding between the US and UK focused on deepening cooperation in advanced technologies. This includes collaboration across artificial intelligence, quantum computing, semiconductors, space, and civil nuclear energy. In tandem, the two governments announced the formation of a new transatlantic task force aimed at exploring ways to ease cross-border access to capital markets and to jointly address the regulatory challenges posed by digital assets and cryptocurrencies. On the civil nuclear front, the US and UK agreed to work together on accelerating licensing frameworks and increasing private sector investment in next-generation nuclear projects, a move aligned with broader energy transition goals on both sides of the Atlantic. Complementing these policy developments were several major private sector investment announcements. Microsoft committed $22 billion sterling to build out its AI and cloud computing infrastructure in the UK, the largest individual investment tied to the Tech Prosperity Framework. NVIDIA announced a large-scale deployment of 120,000 GPUs across the UK, supporting the UK expansion of OpenAI's Stargate project. Google committed around £5 billion to new data center development. Other US tech companies, including Oracle, AWS, and Salesforce, also announced additional investments as part of the broader initiative. In the energy sector, an agreement between Centrica and US-based X-Energy was unveiled to deploy up to 12 nuclear reactors in the UK. This would generate as much as 6 gigawatts of energy, part of what the government is calling a golden age of nuclear. Additional energy partnerships were announced as a part of that 6 gigawatts, bringing the total investment in this area to over £24 billion. These are some meaningful sums. And if that weren't enough, the approval of a new runway at Gatwick signals a renewed focus on infrastructure and construction, one that could fuel a capex-driven growth cycle in the years ahead. For the new Labour government, the challenge will be ensuring that these deals translate into real economic momentum and don't get stalled in bureaucracy or bat tunnels and local opposition. Despite these positive headlines, recent data reminds us that the underlying growth picture remains delicate. Purchasing Managers Index data released on Tuesday showed a contraction in manufacturing activity and generally weaker than expected results across both the UK and in continental Europe. For those less familiar, PMIs are forward-looking surveys that capture the sentiment of business across a range of indicators, including hiring, production, supplier deliveries, and new orders. A reading above 50 suggests that the economy is expanding, while a reading below 50 indicates contraction or expected contraction. The UK's latest composite PMI came in at 51. That's still above the expansion threshold, but it's down from the previous month and below expectations. While services remain resilient, manufacturing and construction continue to drag on the recovery. This could simply reflect a pause in business activity ahead of the budget, as firms wait for greater clarity before committing to new investment. Encouragingly, the Confederation of British Industries survey of manufacturing orders improved from its June lows, although it does remain in negative territory overall as well. In the Eurozone, the composite PMI came in at 51.2, a modest improvement from last month and slightly better than consensus forecasts. But, just like in the UK, this was driven almost entirely by the services sector. Manufacturing, unfortunately, slipped back into contraction. This is disappointing after several months of gradual improvement. While it's possible that the summer period has introduced some seasonal noise, the broader concern is whether a true cyclical turnaround is taking hold or not. Germany's services sector continued to expand at a healthy pace, but its manufacturing sector remained in contraction. Meanwhile, France continues to struggle, with both manufacturing and services showing declines. Now, zooming out to a more global perspective, there's another important development that should be on the radar of European investors, and that's the shift in Chinese trade patterns. As the U.S. administration ramps up tariffs on Chinese goods, Chinese manufacturers have begun reorienting their exports away from the U.S. and towards the rest of the world. According to a recent Bloomberg report, container volumes at Chinese ports are at multi-year highs, and international air cargo is surging. Despite exports to the U.S. falling by more than a third, China's trade surplus has reached a record $1.2 trillion. This raises serious implications for Europe. Even before the U.S. introduced its latest round of tariffs, China was already the subject of a record number of trade challenges with the World Trade Organization. Those numbers are likely to increase. European manufacturers are now facing a wave of ultra-low-cost Chinese goods flooding into global markets, a disinflationary force that will be hard to ignore. In sectors like electric vehicles, Chinese producers have shown little sign of slowing down despite the imposition of EU tariffs. There is also the risk of so-called washed goods, Chinese products that are rerouted or relabeled via third countries to skirt tariff rules, making their way into the European market and the US market. As Brussels seeks to diversify trade relationships beyond the US, it will need to be vigilant. While the US may risk stagflation due to sticky inflation and slowing growth, Europe could face the inverse, persistently low inflation despite ongoing stimulus, driven in part by this surge in low-cost imports. However, we put a low risk on this scenario being significant. So, what does all this mean for credit investors? Credit markets have seen a modest pullback recently, with spreads moving wider, but in the broader context of 2025, spreads remain at constructive levels. Some pause is natural, especially at this point in the year. Investor expectations for a European recovery have been high, but the data has yet to deliver a clear confirmation. The PMI results discussed earlier underscore that while the region is expanding, the recovery remains fragile. Nonetheless, credit continues to offer compelling value. Government bond yields remain elevated, which provides an attractive base for income. At the same time, we expect continued strong supply as both public and private entities ramp up CapEx spending, particularly in infrastructure, energy, and technology. Risks, however, do remain, especially around execution. Europe continues to struggle with delivering on its policy ambitions at the pace required. But despite that, we believe the outlook for European credit remains solid on a relative basis as we head towards 2026. That's it for this edition of the Credit Compass. If you enjoyed today's episode, don't forget to follow, rate, and share. And if there's a topic you'd like us to cover, drop us a line. We'd love to hear from you. For deeper research and credit ratings, please visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.